Look around for a second. The house someone lives in, the business they are building, the road they drive on, the government that funds the country, even the bank account they check every morning, almost none of it was built only with money people already had. Most of it was built with promises. Promises about future income, future taxes, future rent, future sales, future work. And the financial name for those promises is debt. Most people hear the word debt and immediately think of bills, credit cards, student loans, car payments, mortgages. But that is only the personal version. Debt is much bigger than that. Debt is one of the main ways the world turns tomorrow into money today. It is how people buy homes before they have the full price, how companies expand before the profit arrives, how governments spend before taxes are collected, and how banks help create credit across the economy. So, before we judge debt as good or bad, we have to understand what it really is. Debt is not just money you owe. Debt is a claim on your future. When you borrow today, someone else receives a claim on income that has not arrived yet. Your future wages, your future business revenue, your future rent, your future taxes, your future production. That is why debt is powerful. It pulls the future into the present. A mortgage is not just a home loan, it is a claim on decades of future income. A business loan is not just capital, it is a claim on future cash flow. A government bond is not just an investment, it is a claim on future tax revenue. A credit card balance is not just spending, it is future labor, being used to pay for today's consumption. Once you see debt this way, the financial world starts to look different. Here's the part most people miss. Debt does not only move money, debt moves time. The borrower gets access now, the lender gets a claim on later. And that exchange is everywhere. Homes, businesses, governments, banks, markets, real estate, credit cards, bonds, private equity, even currencies. Debt is not sitting on the edge of the economy. It is built into the center of it. This is why debt is usually misunderstood. People talk about it like a moral issue. Debt is good, debt is bad, debt is smart, debt is dangerous, but debt is not moral by itself. Debt is a tool, and like every tool, the result depends on how it is used. A hammer can build a house, the same hammer can break a window. The hammer did not change. The use changed. Debt works the same way. If debt is attached to something that produces income, it can become useful. If debt is attached to something that only consumes income, it can become pressure. That is the first real filter. Not how much did you borrow, but what did the borrowing create? Did it create cash flow? Did it create capacity? Did it create an asset? Or did it only create a payment? Imagine two people borrow the same amount of money. The first person buys a small, boring business, maybe a repair shop, a cleaning company, a local service business, something ordinary. But it has repeat customers, healthy margins, and enough cash flow to pay the loan. The business is not glamorous, but every month it helps carry the debt. The second person borrows the same amount, but this person uses it for a lifestyle. A nicer car, better furniture, trips, clothes, restaurants. A version of success that looks good from the outside. At the beginning, both people feel like they gained access. Both got the money, both unlocked something they wanted, but only one bought something that can help pay the debt back. The first borrower bought a machine. Not literally a machine, but a financial machine, something that can produce income. Even after the money was spent, the second borrower bought a feeling, comfort, status, image, memory. There is nothing wrong with comfort, but financially, that structure is very different. One debt is supported by cash flow. The other is supported by the borrower's ability to keep working. And this is where debt starts to control people. Because the lender does not care. Why the money was borrowed, the lender does not care. If the purchase felt important, the lender does not care. If the borrower had good intentions, the payment still comes due. The interest still grows, the future still has to pay. For the decision made in the present debt only asks one question: can you repay? That is why debt attached to cash flow can become leverage, and debt attached to consumption usually becomes pressure. Leverage simply means using borrowed money to control something larger than your own cash would allow. That is why real estate uses debt. That is why companies borrow. That is why governments issue bonds. That is why banks matter so much. But leverage is not magic. It only magnifies the structure underneath it. If the asset is strong, the cash flow is real, and the terms are manageable, debt can accelerate growth. But if the asset is weak, the income is uncertain, and the repayment schedule is tight, debt can turn a small problem into a much bigger one. This is the strange thing about leverage. It can make good decisions better, and bad structures collapse faster. During good times, debt feels easy, income is coming in, banks are lending, asset prices are rising, interest rates feel manageable. Everyone feels smart. Because the environment is friendly, then the environment changes. Revenue slows, tenants leave, interest rates rise, a loan needs refinancing. The bank becomes stricter, and suddenly, the same debt that once felt like a tool starts feeling like a cage. The debt did not change, the conditions changed, and conditions reveal the truth. Debt has a demand built inside it. It demands consistency. The borrower can have a great plan. The asset can have a great story. The market can be exciting, but the payment schedule does not care about the story. It arrives on time. Every month, every quarter, every maturity date. This is why cash flow matters so much. Cash flow is not a fancy finance word. It is the money that actually moves. Money coming in, money going out, money available to pay obligations. Paper wealth does not pay bills. A high valuation does not pay suppliers. A nice lifestyle does not pay debt. Cash flow pays obligations. And if you want finance explained this way, through real systems, clear stories, and simple examples, subscribe to Wealth with Nina. Now let's go deeper. A company can look valuable and still run out of cash. A real estate investor can own several properties and still be trapped. If the properties do not produce enough net income, a high-income person can earn more than most people and still feel broke. If every dollar is already promised to payments, debt reveals whether the structure is real, because when the payment comes due, the image does not matter. Only the cash flow matters. This is where debt becomes bigger than personal finance. Because the whole modern economy runs on promises about the future. A bank lends because it believes the borrower will repay. A company issues bonds because investors believe future earnings can support the interest. A government borrows because buyers believe future taxes, future growth, and future credibility will be enough. The modern economy is a network of promises. Debt is the contract that makes those promises spendable today. This is why banks are so important. A bank does not only store money, a bank allocates trust. When a bank lends, it is making a judgment about the future. It is saying, this borrower will probably repay. This asset is acceptable, collateral. This cash flow is strong enough. This risk is worth taking. That judgment can create access. And in modern banking, that access can help create new deposits. When a bank approves a loan, the borrower receives a deposit. The bank records a loan asset. The balance sheet expands. That means credit creation and money creation are deeply connected. Money and debt are not separate worlds. They are linked in many cases. New money enters the economy because someone borrowed first. Someone borrows, a deposit is created, spending begins, An asset is purchased, a business expands, a house gets built. A project starts, credit can create growth. It allows people to act before they have saved all the money. That can be powerful. A family can buy a home, a business can buy equipment, a city can build infrastructure. But credit can also create fragility. If too much credit flows into real production, the economy may grow. If too much credit flows into speculation, prices can rise faster than value. If too much credit flows into consumption, people may look wealthier, while their future income is being claimed quietly. Debt does not only change balance sheets, debt changes behavior. When credit is easy, people take more risk, buyers pay higher prices, companies expand faster, investors accept thinner margins, households stretch for bigger homes, bigger cars, and bigger lifestyles. Easy money makes the future feel cheaper. But when credit tightens, everything reverses. Borrowers become cautious. Banks protect themselves, investors demand higher returns, asset prices fall, and people who depended on refinancing discover that access to credit was never guaranteed. That is when control shifts. The person who needs money loses power. The person who has liquidity gains power. Liquidity is not looking rich. Liquidity is having usable money when it matters, not theoretical wealth, not a hopeful valuation, not an asset that might sell one day. Usable money in a debt-driven world. Liquidity is survival. This is one of the cruelest parts of debt. You can be right in the long term and still lose because the short term arrives first. A real estate investor may believe a property will be worth more in 10 years. And maybe that is true. But if the loan resets next year and the cash flow cannot cover the new payment, the 10-year vision may not matter. Debt compresses time, it forces the future to answer on a schedule. That is why serious operators care so much about terms. Beginners look at the interest rate. Operators look at the agreement. When does the loan mature? Is the rate fixed or variable? What happens if revenue falls? What is the collateral? Can the lender demand repayment early? Can the debt be refinanced? How much room is there for things to go wrong? These questions sound boring until they decide who survives. Debt agreements are not just paperwork, they are control documents. They decide what happens when the original plan fails. During easy times, everyone talks about upside. During hard times, the contract speaks. This is why debt can quietly control assets, even when the borrower appears to own them. A person may own a house, but the bank has a claim. A company may own equipment, but lenders may have rights over it. A founder may own shares, but debt covenants can restrict decisions. This is also why governments are not only political machines, they are debt machines too. Governments borrow to fund spending today. Then they rely on future taxes, future growth, and future credibility to service the debt. When investors trust a government, that government can borrow cheaply. When trust weakens, the cost of borrowing rises, and the country has less room to maneuver. National debt matters because debt changes flexibility. Debt is not judged only by size. It is judged by structure, credibility, currency, interest, cost, growth, maturity, trust. The same idea applies to people and companies. $1 million of debt can be safe or dangerous. It depends on the income behind it, the assets behind it, and the terms attached to it. The number alone is not enough. The structure explains the risk. This is why inflation and debt are connected. Inflation reduces the purchasing power of money over time. For borrowers with fixed-rate debt, inflation can make old debt easier to repay if their income rises. While the payment stays the same, for lenders, inflation can reduce the real value of the money they receive back, but if interest rates rise, new debt becomes more expensive, and weak borrowers get exposed. Debt always lives inside the interest rate environment. When rates are low, people can afford larger loans. Asset prices often rise because buyers can pay more while keeping monthly payments manageable. When rates rise, borrowing power falls. Assets may reprice, weak structures become visible. This is why the cost of money shapes the price of assets. People often think prices move only because of demand. Demand matters, but financing conditions matter deeply. A house is not only priced by what people want, it is priced by what lenders will finance and what buyers can afford each month. A company is not only valued by its story, it is also valued by the cost of capital. An investment is not only attractive because the return looks good, it has to be compared against what money costs. Debt sits underneath the economy, like gravity. You may not see it directly, but it affects almost everything. That is why debt controls the world. Not because every borrower is powerless, not because every lender is evil, but because debt organizes claims on the future. It tells the borrower, you can access value now, but part of your future belongs to repayment. It tells the lender you can earn a return if the future arrives as promised. Debt also tells the economy growth can happen faster than savings alone would allow, but it creates one condition. The future must be strong enough to pay for the present. When that condition holds, debt can build. When that condition breaks, debt controls. This is the difference between productive debt and fragile debt. Productive debt is connected to cash flow, assets, or capacity. Fragile debt depends on optimism, refinancing, rising prices, or income that may not be stable. The difference is not always obvious at the beginning. In the beginning, both types of debt provide access. Only later do you discover whether the access was building control or giving it away. That is the personal lesson. Do not ask, only can I afford the payment? Ask, what is this payment doing to my future? Is this debt helping me own something productive? Is it buying time, capacity, or a system? Does the asset produce cash flow? Can the structure survive stress? Could I handle lower income, higher rates, or delayed results? Or is this debt only helping me look successful? While reducing my freedom, those questions are uncomfortable, but they are useful because debt hides inside normal life. Monthly payments make expensive things feel manageable. Financing turns large prices into smaller numbers. Easy credit makes the present feel generous, but every payment is a promise. And too many promises can turn income into something you no longer control. That is why high income does not always create freedom. If every dollar is already assigned, before it arrives, income becomes a pass-through. It enters the account, pays lenders, pays bills, supports the lifestyle, and leaves. The person may earn a lot, but their future is crowded with claims. That is what debt does. When it is not managed carefully, it colonizes the future. But debt can also do the opposite, used with discipline. It can help someone acquire assets sooner, build a business faster, smooth cash flow, invest in productive capacity, or survive temporary pressure without selling something valuable. That is why serious financial education cannot simply say, avoid all debt. That advice is too small. People need to understand how debt works because wealthy people do not avoid debt completely. They study it. They study the terms, the cash flow, the downside, the collateral, the timing, and the exit. They do not ask only, can I borrow? They ask, should this structure exist? That question changes everything. Most people treat debt like permission to spend. Operators treat debt like a financial instrument that must justify itself. If borrowed money does not increase capacity, protect liquidity, or acquire something valuable, it may only be moving pain from today into tomorrow, and tomorrow usually charges interest, so the lesson is not that debt is evil. The lesson is that debt is serious. It is one of the most powerful tools in the world because it connects money to time. It can build cities, homes, companies, roads, factories, and entire economies. It can also trap households, bankrupt businesses, destabilize governments, and turn temporary mistakes into long-term obligations. The same mechanism does both. That is why debt controls the world, because the modern world is built on promises about the future. And debt is the contract that makes those promises spendable today. If you understand that, you stop seeing debt as only a bill, you start seeing it as a transfer of control. Sometimes control moves toward you, sometimes control moves away from you. The difference is structure, the difference is cash flow, the difference is discipline. The most important question is simple. Does this debt help my future produce more? Or does it force my future to pay for my past? That is the question worth remembering. Debt gives you access to tomorrow. But if you are not careful, tomorrow will own you. If this video helped you see debt differently, subscribe to Wealth with Nina. This channel is about understanding the hidden systems behind money banking, wealth markets, and financial power. Because the more clearly you understand the system, the less likely you are to be controlled by it.